With the stock market going up and down a lot lately, more and more companies are joining the 52-week low list. And it has to be said that this list gets really interesting with a few big names on there. What about Nike, Dollar General, or Krispy Kreme, to name a few? 52-week low stocks are always interesting to look at. Personally, I'm looking for an overreaction, where investors sold the stock while the company is showing signs of recovery. In this video, I will quickly discuss 6 companies and show you my price target for these stocks. So without further ado, let's dive into the first company, which is the iconic Nike, the stock that everyone is talking about as of lately. Nike is down 30% on the 1-year chart, and it is not looking pretty. Currently sitting at $70, which is also their 52-week low ranking. Nike is a 105 billion market cap company, and PE ratio is hovering at 21, potentially indicating that Nike stock is undervalued. Revenue went up really steady and consistent, and this used to be one of the cornerstones of this company. They were performing really steady and consistent. However, most recently they are struggling a lot with that growth. And not only that, but margins are also a roller coaster. It was expected that margins would significantly improve by cutting the middleman. Unfortunately, that didn't happen. But there's also an interesting side effect when a company goes down in ticker price. Dividend yield increases a lot because of it. And as of right now, Nike pays a 2.25% dividend yield, which is really nice. The company is struggling, but they maintain that dividend focus. Payout ratio is looking really good at 43%, leaving 57% cash for investing back into the business. And those growth stats are also pretty impressive. Looking at the historical growth pattern, it is also looking steady and consistent. Analysts expect an increase in dividends in the coming years, which is also very nice. And now the part you have waited for, the price targets, and I'm using a high mid-low scenario. I'm willing to pay a small premium for the stock, since they are the market leader in many areas. I hit analyze, and we see a few green numbers. We have a low price target of basically $39 to $43. With a mid-price target of $53 to $58, and we have a high price target of $72 to $79. And to be honest, I think the high price target could be justified here, indicating that Nike stock is undervalued. However, there is a big but. The company needs to recover and get back on their feet. So Nike, just do it. Moving on to the second stock, the Boston Beer Company, ticker symbol SAM. This stock is down 16% year to date, hovering around $250, which happens to be its 52-week low. The bulk of volume and revenue is concentrated in 4 brands: Samuel Adams, Angry Orchard, Twisted Tea, and Truly. This is a 3 billion market cap company with a PE ratio of nearly 37, so we're not off to a great start, to be honest. It's trading at a premium, even after a 16% decrease in ticker price. Revenue is somewhat flat over the past few years, so this also doesn't look that great, especially since they had a great run-up before the lockdown periods. Margins went down big time, but over the recent quarters it started to increase again. Most recently they went down a little. The Boston Beer Company doesn't pay a dividend as of right now, and to be honest, I think they should focus on getting those margins up again before starting paying dividends. For the price target, I fill in the 3 assumptions, and the tool will give me a low mid-high price target. In the case of the Boston Beer Company, I'm willing to pay a small premium because of historical performance. I hit analyze, and we see a lot of red numbers. We have a low price target of $90 to $135. We have a mid-price target of $140 to $200, and we have a high price target of $217 to $219. So it looks like the stock is still overvalued. And in my opinion, two things need to happen. 1. The company needs to improve their margins and get that revenue growth back. And 2. The stock needs to come down a bit more before becoming an interesting value play. Another interesting stock to discuss would be Dollar General, down 50% on the 1-year chart, hovering at $68, which is also their 52-week low. This company is known for having a hard time lately, so let's see what happened. Dollar General is a 15 billion market cap company with PE ratio at 11, which is insanely low. But keep in mind that companies like Dollar General tend to have a lower PE ratio in general. Revenue is actually looking pretty good to me. I was expecting some flat numbers here, but it keeps on growing. But the real problem lies in their margins, going down big time in the recent years. A potential red flag for me, since there are no signs of recovery. And with the stock hammered down a whopping 50%, the dividend yield increased over time to 3.4%, which is a crazy high number for this type of company. Payout ratio is actually really low at only 39%, leaving 61% of the cash to be invested back into the business. And the growth numbers are also pretty impressive, I must say. Historically, the dividends have increased at a decent pace as well. And for the upcoming years, analysts expect a slight increase, which is also very hopeful. And now the moment everyone waited for, the price targets. And for this, I'm using a high, mid, low scenario. I'm putting in pretty conservative numbers in my opinion. We hit the analyze button, and we see some green numbers. We have a low price target of $35 to $52, a mid price target of $57 to $77, and a high price target of $58 to $107. And to me, the mid price target is the most justified here, indicating that this stock is a potential buy. And I was a bit surprised about these price targets, so I'm definitely doing a full deep dive in the company anytime soon. Next up is Restaurants Brands International, ticker symbol QSR. This stock is down 21% on the 1-year chart, hovering around 52-week lows. QSR is one of the largest restaurant companies in the world. Their portfolio includes Tim Hortons, Burger King and Popeyes. QSR is a 27 billion market cap company, with PE ratio at 21, which is a really interesting number. Revenue is increasing in the long run, which is looking really good. Margins are up in the long run as well, also looking really good, and most recently they took a small hit. Dividend yield is sitting at 3.8%, which is a great number. Payout ratio is sitting at 70%, which is a bit on the high side of course. This means only 30% goes back into the business. The growth stats also look pretty impressive. Looking at the historical chart, we see that there in 2018 was a massive spike in dividends paid. After that, they slowly increased it. For the upcoming years, analysts expect a similar pattern. For the price targets, I'm again using the 3 scenarios. I hit analyze, and we see a few green numbers. We have a low price target of $40, a mid price target of $58, and a high price target of $80. To me, the mid to high price target is the most justified here, indicating that QSR could be undervalued based on these numbers. And next up is Krispy Kreme. This stock is down a massive 38% on the 1-year chart, trading at their 52-week lows. Krispy Kreme is a 1.5 billion market cap company, with PE ratio at 52, which is insanely high, potentially indicating this stock is overvalued. But hold your horses, since PE ratio only tells a small part of the full story here. Revenue used to go up at a pretty steady and consistent pace. However, most recently it is slowing down quite a bit. The good part is that margins are increasing, and that was much needed since the company reported negative margins historically, also due to the fact that it is relatively young. The current dividend yield is at 1.6%, which to me feels a bit weird. This company is barely profitable but decided to pay a dividend. Payout ratio is at 70%, which to me feels as the wrong decision again. I think this company was better off investing that money in opening new stores and improving their business. Now they only have 30% left to do exactly that. For the upcoming years, it is expected to increase at a decent pace, which is very interesting to say the least. For the price targets, I'm again using the 3 scenarios. I hit analyze, and we see a few green numbers. We have a low price target of $1, a mid price target of $4.5, and a high price target of $9.5. And to me, the mid to high price target is the most justified here. So depending on how you look at this company, it could be undervalued. But in my opinion, the company needs to improve their margins and business in order to become an interesting value play. But it has to be said that there is something interesting about this company. It has potential. Another company with a lot of potential is Papa John's, ticker symbol PZZA. This stock is down 52% on the 1-year chart, which is insane of course. Papa John's is one of the largest players in the pizza market, with more than 6,000 restaurants across nearly 50 countries. Papa John's is a 1 billion market cap company, with PE ratio at 12.5, potentially indicating they could be undervalued. Revenue used to go up at a steady and consistent pace. However, most recently they are struggling a lot. And they are also struggling with the margins, but most recently the trend is going up, which is the silver lining here. And one of the crazy things about this company is the fact that dividend yield is hovering at 5%, which is crazy high of course. Payout ratio is also a bit on the higher side with 70%, leaving only 30% for investing back into the business. Growth stats are really impressive if you ask me. Looking at the historical chart, we see that they increased the dividends at a decent pace. But it came to an end in the lockdown periods, which only makes sense if you ask me. It is expected that dividends will keep on increasing in the coming years as well. For the price targets, I'm again using the 3 scenarios. I hit analyze, and we see a few green numbers. We have a low price target of $14 to $24. A mid price target of $24 to $33 and a high price target of $36 to $43. And hear me out. To me, the high price target is the most justified here. So this could indicate that they are undervalued. But keep in mind that this is based on future growth. And again, it's the same with Krispy Kreme. There is something interesting about this company. And this was the full list of stocks that are trading at 52-week lows that have my interest. I think it's an interesting mix of different type of companies at different stages. One thing is sure about these companies, they all took a big hit and are struggling with their revenue or margin, and in some cases even both. I do expect that most of these companies will recover in the future, but only time will tell. For now, I'm going to analyze these stocks even more and keep a close eye on the stock price. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.